Folks, if you've heard me talk about commercial real estate, you have heard me talk about a lot of great pain coming. I want to highlight a video from a syndicator back in the day. Yes, the one and only Mr. Jonathan Twombly, where he called his shot and exited the market early. Now, in hindsight, he exited a little early, but I do appreciate that somebody was looking at the market and said, you know what? I need to protect my investors. Here we go, and sold his portfolio. So here is that discussion. Here is what we talked about.
Hey everyone, I have a very exciting show for you today, if not a little bit different than a lot of the podcasts or interviews we've done on this channel. And I say that because a lot of the discussions we've had with investors are really about exciting and big plans and, you know, the next thing and the next deal. And I was attracted to Jonathan Twombly because of a post he had where he indicated basically said, I'm out, pulled the ripcord. So I'm like, I got to get this guy on the phone because he kind of sees the world the same way I do. We've invested through a cycle before, and I'm like, and we finally got it done. So let's welcome Jonathan Twombly to the show. How you doing this morning, Jonathan?
I am great, Michael. Thank you for having me on the show.
Oh, it's wonderful, Jonathan. Why don't we first introduce the world to you, sort of who you are, what you are in the country, what do you kind of do, and we'll go from there.
So as you said, I'm Jonathan Twombly. I am a former Wall Street lawyer who is now a real estate investor, do a syndication business. I'm based here in Brooklyn, New York, but we invest out of town. So all of the stuff that we had bought and sold is in the South Carolina, well, not the South Carolina area, in South Carolina. We ramped up to about 400 units. It's worth $25 million at the time that we sold. We just closed on that in the end of February. And now I'm just preparing for the next go round, whenever that's going to happen.
Yeah. So let's be clear. When you say exited, like you holding nothing right now.
I sold it all. I sold the whole thing.
So, you know, where some people are talking about going all in, you know, seeing roses, rainbows, and unicorns in the future, you're seeing obviously danger signs. And so what is it you're seeing that decided you to take your chips off the table and go back to your room and call it a night?
So there are really a lot of things. I mean, I'm not going to proclaim that I have any kind of crystal ball. You know, I don't think I'm reading the same thing everybody else is reading, but my interpretation of it is different. And I think it's because I'm fundamentally like kind of a contrarian investor. Whenever anything is too hot, it scares me. Whenever anybody's complaining about stuff, I start asking why. Like, why do they think this is so bad, right? So I'm always looking for the opposite angle. Like, so I got interested in South Carolina in the first place because everybody was piling into Texas, and that just instantly made me nervous, right? I was like, okay, if everybody's going there, it's either overpriced or like there's some hype going on, because it can't possibly be that good, right? And so I started looking for other stuff. I was like, well, what else is going on? And I noticed that, you know, the demographics in the Carolinas were pretty much as good as Texas, but nobody was saying anything about them, right? It wasn't on anybody's radar, which to me was like, okay, that's like crack. Like I had to go after that. Then what happened is eventually the market catches up, right? You can't hide that data forever.
Yeah. And
especially when people start seeing like how overpriced Texas was, they did the same thing as me, started looking around for other opportunities. Now the opportunity in the Carolinas is gone because everybody's piled in there too. You know, and over time, everybody's piled into everything. So that's like with that background of wanting to like look where people aren't looking and not just follow the crowd. Because I don't think you make money following the crowd. I think usually by the time you hear about what the crowd is doing, it's already too late. And that's like your typical new investor story. By the time they hear about any opportunity, that opportunity is long gone, even though they convince themselves that the opportunity still exists. So I'm a student of markets. I'm really fascinated by the way the markets work. I'm fascinated with behavioral economics, and just looking at how long this cycle had gone on, how overpriced assets were compared to their historical, long-term averages, the kinds of cap rates people were paying for assets, which made no sense. Like I couldn't understand, for instance, why 5 years ago, people would only, they needed to get 8 cents to spend $1. And then 5 years later, they're willing to expend that same dollar for 4 cents or 5 cents. Like, I don't understand. Nothing has changed, right? It's the same dollar, right? So why is the dollar worth half as much to you now? That all has to do with psychology, right? It's investor psychology, has nothing to do with economics, nothing to do with fundamentals.
Yeah.
So all of that combined to make me very, very anxious and, think, and markets always crash from the top, right? They don't crash from the bottom. They crash when everybody thinks that this is going to go on forever. And when you start hearing the stories in the market of it's a new paradigm, or this time is different, and when people can start giving you laundry lists of why like crashes aren't going to happen anymore. I mean, I just read an article yesterday about a bunch of people running around out there talking about the stock market, about how because of the Fed's loose money policies, we're never going to have another recession again. Like, honestly, these are like people being interviewed on TV who are supposedly professionals who are saying we're never going to have another recession again because the Fed has got it all figured out.
Wow.
As soon as you start hearing that stuff, that's the signal that it's time to run for the exit, right? So that got me thinking about, okay, really sort of strategically, what should I be thinking about my business? And a couple of things kind of fed into the decision. Like, one was that, well, the very first thing that made me start thinking about it was I had one deal that just was like just a dog of a deal. Like, everybody's got one, right? Like,
yeah,
this deal just had everything go wrong with it that could possibly go wrong with it. And I only had one investor in that deal, and he said, look, Jonathan, just sell this thing. It's just not, it's like, I want to just use the money for something else. Let's just go do something, like just sell it. And that got me thinking, like, this is actually a pretty good time to sell. And I started thinking more and more about it and thinking, like, what, I actually feel like I have an obligation to my investors to sell now, because I don't think the prices can go up any higher than they are right now. But I think there's a great chance that they will go lower from here. Mm-hmm. So my choices are, I can either sell now, make really fantastic returns for my investors, make everybody very happy, lock in a track record, set myself up for future success, or I could miss the window, right?
Yeah.
I mean, maybe we'll have another good run for next year or two, but basically miss that opportunity to sell. And then, frankly, either be looking at, refinancing in a different environment in a couple of years, or trying to sell in a couple of years when it's really uncertain. Yeah. I could tell you what the market is right now. And the market right now is the seller's market. And if you hold assets, it's a great time to sell. I can't tell you what the market's going to look like tomorrow or a year from now or 3 years from now, when we would have to refinance our debt. So it seemed to me when you combine all of those things together, just the signals were just flashing like sell. Make the money for your investors now while the going is good, and then start focusing on the next cycle.
There's so many questions there, and thank you for all of that. I have so many questions about what your activity is today, but let's not be remiss and talk about how long it took you to build this portfolio that was eventually sold for $25 million, right? When did you start? How many kind of assets? And let's paint the picture of the present that ultimately became the $25 million exit.
So, yeah. So, it's a long story. This didn't happen overnight. There was a lot of struggle up front. I'll try to condense this as much as possible, but it took me so I was in a fortunate position. Let's back up even further. I was in a fortunate position to be able to do this full time from the start, because on the one hand, I lost my job as a lawyer, right? Mm-hmm. But I was done. I was burned out. I had no interest in going back to it. So when I lost my job, I was actually happy about it. And I also lived very frugally up until then. So I'd saved a lot of money, and I was able to say to my wife, like, hey, I'm going to take a chance on something else, right? So we had that cushion to fall back on, right? Yep. So I was in a fortunate position where I could focus on this full time. That being said, it still took me 3 years to get my first deal closed. I had a couple of years and a different partner, and we got a couple deals under contract, and it was back in 2011. It was, banks were still skittish, and we had banks back out on us. We had all kinds of stuff happen, and wound up breaking up because we just thought the world is telling us something. Maybe we should just go our separate ways.
Yep.
And then I formed this business that I have now, and it still took me a year to get that first deal closed because of all of the newbie stuff that you go through, like all of the effort it takes to get brokers to take you seriously. And this was, and frankly, I had money. Like I had friends, I had deep-pocketed friends who were like, Jonathan, we'll invest with you if you do this. So I didn't have to worry about the money part of it, but just getting the deals even with the money. And this is 2013, not 2019, when deals were a lot easier to come by, and it still was very difficult to get the real good commercial brokers to take me seriously.
Yeah.
So it took me a year for that to happen. Then once we got that first deal, then, basically over the course of 11 months, we closed on 3 more and built the whole portfolio over the course of I guess really sort of end of 2013 to beginning of 2015. So it's like a year and a half.
Okay.
But between the first signing of the first contract and the closing of the last one. And then what happened was by 2015, I'd noticed that the prices were really starting to ramp up. And we continued making offers, but basically what happened was we were getting the difference between our offers and what the sellers wanted was getting bigger and bigger and bigger, right?
Yeah.
So we weren't following the sellers up in their pricing demands. We sort of stuck to our guns, but it just started getting, we just were getting priced out by even more and more and more. And by 2016, then prices were really off the charts. And if you kind of look at the data looking backward now, you can see that the peak was reached in 2016, and it's just been flat ever since then, right? And pricing hasn't been able to go higher because it just literally can't go any higher than it is now, but it's been sort of stuck there. So we didn't buy anything after that point because, just waiting for things to calm down, which they didn't. I know we're going to talk about probably the explosion of syndicators later, but I also kind of, looking back on things, I also believe that 2016 is really when the syndication explosion happened. That's when I started to see just people coming out of the woodwork, people who had found me somehow in 2014 and called me for advice and were like, I don't know what to do with my life, and maybe I'll buy a single family house. I was seeing syndication offerings from these people, and at that point, I just think that there's a connection between these two things, that the pricing of assets being so high, the explosion of syndication, the availability of just tons of money, just led to this point where we hit this plateau in 2016, which I think, the longer it goes, the more likely it is to collapse. But
and collapse spectacularly. So again, let's put the bow on the portfolio, the present that you built with your investors. So four assets, total unit count, all in South Carolina. What city?
So half of it was in Greenville, and half of it was in Spartanburg.
Okay.
So there used to be one MSA, but it was split up in the last census. But they're basically 30 minutes apart along the I-5 corridor in Western South Carolina. It's very heavily fast-growing part of the state. Oh, well, here's another thing too, that went into the decision-making to sell.
Yeah.
So I noticed a couple of things about the last recession, and I think that these are kind of common to all recessions, but there's a lot of talk out there about how C-class property and rental property does well in recessions, right? There's been this narrative that's been composed over the last, 10 years or so. It's not true, right? When you have a recession, people lose their jobs and they can't pay rent. And the lower down they are on the economic spectrum, the more jobs they lose and the less they can pay their rent. So and manufacturing gets whacked really badly in recessions. So here I was in a market with C-class properties, right, in a heavily manufacturing part of the state, right? And that started making me really nervous thinking about where things are going, right? Like I didn't really want to be holding on to C-class properties that are already vulnerable anyway in a manufacturing area, which is going to be vulnerable in a recession. And, just felt like the time to exit, all those things put together, super high, crazy pricing, looking at vulnerability on the downside coming up when the recession hits. It's going to hit. We know it's going to hit at some point. Yeah. So those things, and frankly, looking at like a property that was struggling even as great as things are now, like what would happen in a recession to that property, right? So that was a scary thought to me. So I thought, like, if I can find somebody, frankly, to overpay me for this property, like, why would I not do that, right? Why would I not sell it? So, and I felt I owed it to my investors to do so. But yeah, so sorry, I got off on a little tangent question, but
it's wonderful. So I just want to wrap this up. So you about 13 or 14 months, sort of start to finish, 4 assets. Then you decide, because you read the tea leaves, you see what's going on, you see the indicators, your experience says, time to exit. So you list it as a package, I'm guessing?
Yeah. Well, so here's what happened. So we actually first tried to sell in 2017, and I had assumable debt on all of the property, and I didn't want to pay the penalties, right? So I listed it as an assumable debt deal, and really didn't get anywhere with it, right? And actually decided, all right, you know what? Maybe we'll just stick with the plan and not sell. But then what happened was but we started getting, we're getting phone calls every day about, will you sell? Will you sell? Will you sell? And finally, some brokers that I know called me up and said, hey, Jonathan, look, we've got some buyers who are looking at your properties. Would you sell? And I threw out basically a, like, go away and leave me alone number. And they said, we'll get back to you. And they came back and said, yes, they'll buy for that price.
Wow.
So, but I had just made the decision at that point not to make an assumption deal. Yeah. And pay the penalties. And even with paying the penalties, the price that was so high that they offered that paying the penalty, it just still made sense, even paying the penalties. Yeah. So, and then at the end of the day, we're still doing the final accounting. We're still like waiting for insurance refund checks, and we're waiting for the last vendor bills to come in and all that sort of stuff that frankly has taken a lot more time than I expected, because this is the first time I've exited. I thought I made the big mistake of like, we closed, and I wrote to all my investors like, yeah, I'll be paying you in a week. Like that turned out to I'll be off by about 12 weeks or so. We're still working on it. I got I figured out that I could return all of their investment. Yes. So I did that, return the investment, but we're still waiting on the accounting. But all that being said, when we wrap it all up in a bow, we're going to have achieved, over 20% annualized returns on these deals, which I feel is great for the that's net of everything. I mean, that's like net 20% to them. Yeah. Annualized for over 4 or 5 years. So that's some of them have basically doubled their money. Yeah.
So I'm guessing, so you gave them a walkaway number of 25 million. They came back and said, cool, let's do it. So it actually never was on LoopNet or MLS or wherever you would post it.
No, the second time around never got listed. The first time around, was a listed deal with brokers in South Carolina who blasted it out to, a lot of people. But the assumption part of it turned people off, right? Yeah. So we just didn't get the kind of offers that we wanted. Okay. But then when the kind of off market, individual calls kept coming, then, like I said, thought, well, this just makes sense to accept.
What was happening is people were, well, let's just talk about it now, right? I think we both feel it in the environment. I don't know anything nearly as large as you, but having apartment buildings just means you're on brokers' radars, and they're just calling you all the time, going, "Will you sell? Will you sell?" I got to create my walkaway numbers. That's a great idea. I'm going to do that today for all my apartment buildings.
Yeah, I mean, it's a great time to do it.
Yeah.
Yeah.
I'm going to do that today. So there's a tip of the day, at least for me. That's awesome. So let's talk about the elephant in the room, right? What changed in 2016? The syndicators. We both have felt that we both see it. I actually refer to it as the Grant Cardone effect. I don't know if he gets the credit or not, but with his YouTube presence and marketing machine, I think there's lots of people that believe they can sort of follow that model, right? Bigger is better, 50 units and above, all of that. Do you see it the same way, or what kind of caused that spark, you think?
Yeah, well, I mean, I think like the really underlying issue is just the availability of so much money in the system, right? There's so much debt, so easy to get debt, and there's just been like a feedback loop that has started where, the people who got in early have been making money, and then that kind of like fuels this narrative of how easy it is. And then, so that's sort of like, the availability of all this cash, I think, is the first piece of the puzzle. But then layered on top of that is like the Grant Cardone and like, other people I won't mention by name because they're friends of mine, but like there are people out there who have created really, really good marketing machines around investing in multifamily, and they, with the help of, say, Bigger Pockets, which didn't exist the last time around, with the help of podcasting, which didn't exist the last time around, the prevalence of Facebook groups. I mean, there's just so many different pieces of this, of the marketing environment that have contributed to the feeling that this is easy, this is safe. And, I've also seen one other thing, and I noticed this really started happening around 2016, is the emergence of specialized money raisers, right? So when I first got started in the business, I had to raise the money on my own. I would get calls from people who were raising money for a fee, right? Which was illegal, but they were all doing it trying to do it under the radar, right? But it was always like 3% for 3% for the capital that I bring you, right? But all of those guys were all like, Jonathan, your deals are too small. You're only raising $1 million of capital. If it's a $5 million raise or a $10 million raise, I can help you. Because they all had like family office and institutional contacts. There wasn't anybody doing it at a lower level. Then what happened was that somebody figured out that it's probably safe to raise money without a broker-dealer license if you become part of the sponsor team, right? So now, from about 2016, I started noticing all these people who were like, decided, they didn't want to be a sponsor, but they're going to raise money for other sponsors. And the way they're going to get around the SEC rules is to become part of the sponsor team, get a piece of the deal rather than a commission, right?
Got it.
It's still an open question whether this is actually legal or not, and we'll see what happens. The SEC may decide to make an example of someone soon, right? But they always leave things vague so they have more flexibility to do what, but it's still an open question. But, on the one hand, like, this is really efficient. Like, I think it's actually, in one way, like, really great that there are people who now are just focused on raising money. And like, if you're someone like me who doesn't really like the money raising part of it, like, you can just focus on doing deals. But on the other hand, it's like, it's just contributed to the more availability of money in the system, and which drives prices higher, right? Just the amount of money in the system. And then, you've got, even some of the bigger coaches out there have got their kind of own ecosystems of people going after, like, raising money together from each other and going after deals and even competing with each other for the same deals in the same markets and driving prices up and like all kinds of stuff. So I just feel like the world is awash in money, right now, and it's causing prices to go up, and that's sort of never a good situation, right? It's always, we wind up at the top of every cycle. This is the same story, just a different form, right?
Yeah, and I want to hit that really hard because you say it so eloquently. I haven't been able to kind of frame it that way, but the thing that scares me, because I invested through the last cycle, right? I started in 2003, so I saw this movie firsthand. But for me, the story or the rhyme, history repeats itself, all of that. People have, 10-year memories and 12-year cycles, all that stuff. It's just the asset class was different. The last time we had this was houses, I think, right? Yeah. Because of HGTV and the flipping shows were the big deal. And then we had Countrywide and IndyMac giving anybody a loan with liar loans, right? So kind of the same story, but the asset class is different. So folks, if you don't remember what happened after 2008, look it up, because that's going to happen again, in my opinion, in the apartment sector, the multifamily sector. Is that a fair analogy or link in your mind?
Yeah, I mean, I think, yeah, because look, what happened the standards for buying single family houses got much tighter after the recession, right? Like they really clamped down on all that stuff. So it became harder to be an investor in single family houses, right? So all the money had to go somewhere, and especially given the fact that like they went in and created all this money out of thin air, right? So all that money now had to go someplace else. And one of the places it went into was multifamily, right? And
interesting.
These things have like, so there's an expression like, what is it? Something like the Fed is always preparing to fight the last recession, or like, the general is always preparing to fight the last war. And I think there's kind of a dynamic where people look around and they say, well, what did well the last time, or what's safe? Certainly I did this too. I got into multifamily rather than, anything else I could have bought, like retail or hotels or industrial or office or whatever, because I went through the thought process like, well, in a recession, all those businesses can go poof overnight, but people still have to need someplace to live. And so multifamily is a good deal, right? So, and I think everybody else also went through that same thought process. But now you have the situation where I think like multifamily is going to be a victim of its own success, right?
Yes.
It did have those characteristics. It still does have those characteristics, but the problem is it makes sense when you pay like one price for it, but it doesn't make sense when you pay another price for it, like a higher price for it, right? So, but because of the perceived safety, everybody has driven the price up. And when you do that, like, like when you studied science in high school and you learned about like potential energy, like the higher you lift the ball off the ground, the more potential energy it has for when you release it. Like markets are kind of like that, right? The higher they go up, the more risk they contain.
Yeah.
They can take the least risk that a market has is after the crash. That's when everybody's scared and they don't want to invest, right? but the market has been de-risked after a crash.
Yes.
The opposite happens though, is when the market is rising, it's basically accumulating risk as it rises. Yeah. But people see it rising and they think it's safe. It's getting riskier and riskier, but the perception from the amateur investor is that it's getting safer and safer and safer because it's going up.
Yeah.
And so you just have this in every single cycle, in every single asset class that there is, whether it's stocks or bonds or real estate. And then, when things go up high enough, then you get the crazies coming out of the woodwork saying it's going to go up forever. And these are the 10 reasons why. And you don't have to worry about any of the risk because there's no more risk in the system.
Yeah.
All the mortgages are, have been collateralized and they're uncorrelated with each other. So they can't all possibly go boom at the same time. Like we've heard that story before, like how there was how risk had been eliminated from the mortgage market because of the way they had packaged those.
I remember.
Right. So now we're hearing the same thing about multifamily.
Yeah.
It has no risk because in a recession it'll do better. That's complete BS. It will not do better in a recession. There's a good chance it's going to do a lot worse. not forever. It's like everything else. It'll go down and it'll come back up. But like if you buy at the top and like you may not survive the bottom.
Yeah, no, these assets are tied to the debt. And if you can't fund the debt, they're going to take the asset. And
exactly.
I've seen it many times. So the other thing I want to hit on, you've hit on it a couple of times, is your obligation to your investors. I talk to, I'll call them new syndicators all the time, right? They kind of seek me out, either to buy my stuff or ask for advice or all of that. But they all seem hyped up on caffeine, right? They're all wide-eyed and eager. And maybe it's your Wall Street background, I don't know, but you seem to come at this from a very measured state with the right attitude and obligation, right? Your decision is first to your investors. And why don't you sort of talk about that and remind other either would-be or people thinking about syndication why the obligation to your investors is so critical?
Yeah, well, I mean, there's a number of different reasons. So there's like kind of legal reasons and moral reasons and business reasons, right? For all of them, right? So, but, coming from the background as a lawyer, we're trained to understand that our obligation is to our client, right? Yeah. We have a fiduciary obligation to our client to put their interests first. So, I had that like whacked into me for 12 years before getting into real estate. So that's just like second nature to me. Yeah. That like my investors their interests come first. Like I have to put them first no matter what. Mm-hmm. And if there's a choice between me benefiting and them benefiting, I have to choose them. Yes. So that is, and when you take other people's money as an investor, right, you are actually legally their fiduciary, right? Yeah. So you have an actual legal obligation to put their interests first. And if you don't, they can sue the crap out of you, right? I mean, not just like get their money back, but punitive damages, and they can get multiples of their money back from you, right? So if you screw over your investors, you are probably looking at bankruptcy, right? Because they're going to take what they invested with you plus everything else you've got, right? So you have this really important legal obligation, like to keep their interests first. Then ethically, of course, like if somebody is like giving you money and entrusting money with you, right? Like I feel very morally obligated to make sure that they make money, even if I am not making money, right? Mm-hmm. That's just, and also there's other things that come with it, keeping them informed. If bad news happens, you have to let them know right away. Like there's, you can't do things that conflict with their interest either, right? You have to, unless it's disclosed and agreed to. So you have like a moral obligation to keep their interest first. And then finally, there's a business obligation, which is like, it's, Warren Buffett sums this up better than anybody. So I'll just quote what he says. Yeah. He says, you have to be long-term greedy, not short-term greedy, right? If you're short-term greedy, which is like you put yourself first, you charge fees through the roof and you get paid whether your investors get paid or not. Like you may be legally obligated to do that because you've disclosed it in all your deal documents and you can't get sued for it. Like it's perfectly legal, right? But if you make a bunch of money and your investors get screwed, they're not going to invest with you again, right? Mm-hmm. So you got a one-time hit and then you're done, right? Yeah. So you want to be long-term greedy, which is think about like, if the shoe was on the other foot and you were putting money with somebody, would you be happy with this deal, right? Yeah. And I think, and from the syndicator's point of view, what I think a lot of people don't really get or don't really think about very much is that the people, for the most part, who are investing in syndications, they are like legally considered sophisticated or legally considered accredited because they meet some kind of criteria. They don't actually really understand these deals very well, right? Yeah. And they are not going to read all the deal documents and they don't understand the underwriting. So they oftentimes are, like they think they're getting a great deal because they got promised an 8%, preferred return, and where else can you get that? Now put aside whether they're, at this point in the cycle, whether they're even going to meet that pref. But, you've got what I call like the 50 dentist deal, and not to disparage dentists, but like their expertise is teeth. It's not sophisticated financial investments, right? So they are going to look at this, they're going to look at the stock market, they're going to look at like CDs, and they're going to say, wow, 8% is great. Now, if there are deals out there that I know of where essentially like, they're going to get that 8% and the sponsor's going to get everything else because of the way the deal is structured, all the upside, all of everything, right? Or there's deals when I first started out, what I was taught to do, I didn't go through any programs myself, but my first partner did. So I kind of like got all the stuff from her. And that mentor was saying basically like, it's a 50-50 split. They put up all the money, you do all the work, you split it 50-50, and it's a great deal for everyone. That kind of works with people who don't really understand how these deals are structured. Yeah. But when I took this to like my Wall Street friends for money, they were like, are you insane? I'm supposed to give you all the money and take all the risk, and I'm only getting 50% of the profits? Like, you must be nuts. Yeah. And so I think that like a lot of sponsors are sort of counting on the lack of sophistication. I don't think consciously, I don't think they're doing this like in a fraudulent way.
No, yeah, agreed.
Like indirectly, like they're doing it, they're kind of counting on subconsciously or without thinking about it, the fact that their investors are not going to push back on this deal.
Yep.
They're not going to push back on these fees. They're not going to push back on the economic split because they can't get a better deal elsewhere. Taking this back to like the fiduciary discussion and like the long-term interests, I feel personally that it's in my long-term interest to make sure that my investors are getting a really good deal. Yeah. Right? This is not an unfair deal. It's not structured to benefit me. Like, I'm going to make money if they do well. Like I certainly want to make money. Like, I'm not in this. This is not a charity.
Yeah.
Right. I'm in this business to make money, and I plan to make a lot of money doing it. But I want my investors to really make a lot of money. Right. Like, I want them to feel really happy with the deal. And if they're ever in a situation where they start digging into the details of my deals, I don't want them to find anything that's going to make them unhappy about this situation. Right.
Yeah.
But I have clients come to me and say, I always tell people, if you're thinking of investing in a deal and you just like want another set of eyes on it, so you get comfortable with it, I'm happy to look it over and give you my thoughts. And I'm not trying to shoot down anybody's deal, but I'm just like, if I see something in there that makes me uncomfortable, I'm going to tell you, right? And if I don't, then I'm going to say, hey, I don't find any, looks perfectly fine.
Good to me. Yeah. Okay.
And I've seen some stuff in some of these sponsor packages, which is just like, I just don't feel it's right. And people have complained to me because they know I'm a sympathetic ear. Like, just last night, I had a drink with one of my investors, and he was like, yeah, I saw this deal, and like, I couldn't believe the fees that this guy was taking out of this deal.
Yeah.
Right. And so, and he's somebody who gets it because he's a Wall Street guy, right? So he understands. But like the doctor who's just focusing on medicine and being a great doctor, and it's just like, what do I do with my money? Oh, this seems like a great deal. I'm going to get 8%, and it's going to be a 20 IRR, and like, they're not unpacking. They're not looking at it and saying, wow, this is a 20 IRR deal, but I should really be getting a 30 IRR in this deal because this is a rich deal.
Yeah.
And like, I should be getting more of it because I'm putting up all the money. Right.
Yep.
They're just thinking, oh, it's a good deal. And they're not kind of like digging into it deeper, but like the sophisticated guys will look at those deals and they'll be like, I don't care that it's a 20% IRR, like 20 IRR. Yeah. Because I know this is a 40 IRR deal, and there's no way that you, Mr. Sponsor, who's putting up little or no money, should be entitled to half of the economics on this just because you found the deal, right? Yeah. So
totally agree.
That's my rant.
Yeah, no, that's awesome. So one of the things I knew I wanted to talk to you about is you've called your shot, and you've called it publicly and said, I'm out. I'm sweeping the chips off the table. I'm going back to my hotel room, right, to use the Vegas analogy. But, the party's still going on, which, parties do. This party could go on another month. It could go on 48 more months. So what does a guy like you who called his shot do? Because you pulled your capital off. You're liquid. Your investors are liquid, and they're happy, which means they want to invest again most of the time. What do? Do you just do you just punch out on vacation for a while and wait till the fire to happen, or do you keep looking? Or I mean, what's a guy do when you call your shot and you did it?
Yeah, I mean, this is a tough, honestly, this is a tough question. And so, I wish I could say I made enough money to like just go off to the beach for the rest of my life, but that wasn't true. I still got to work for a living, right? So, so what do I do now? Well, one thing that I am doing is continuing to bring investors onto my platform to get ready for the next time.
Okay.
Right? So I do believe that there will be bargains again in this.
Yeah.
It always happens, right? The business cycle hasn't ended yet. They haven't repealed that law yet. Right?
That's a good one.
The law of gravity has not been repealed yet, right? So it's going to happen again. But you ask a good question, like, well, how long can I wait this out, right? Yeah. And it is a good question. If it goes on for 5 more years, honestly, like I'm screwed. Like I don't know. I can't just sit on my hands for 5 more years, right? Yeah. Like it's just like I'll be out of business.
Your investors would get itchy, right?
They'll go to someone else or whatever. Like, but I my assessment of the risk hasn't changed. Like there's not anything that's going to tell me like if this goes on for another year that well, things have changed and now the market's going to continue to go up. Like at best, it's going to hold where it is for a while.
Okay.
At best. And so what I'm doing, as I started saying before, is like I'm talking. I still bring investors in. I have a conversation with them. I explain my philosophy, explain my view. I say, if you're patient, join my platform. You don't have to really do anything. There's no obligation. You don't have to do anything on my platform. But if you're a patient person and you don't need the money, you don't need to spend the money this minute, join my platform. I'll tell them, like, if you do need to spend the money right now, I can introduce you to 10 friends who are doing deals right now, and you can invest with them. And I'm happy to do that too. But for my platform, this is a patient platform. We're waiting for the time when the real bargains come. In terms of, making a living, I'm building out a coaching platform. It's something I love teaching this stuff. And I also feel like there are some excellent teachers out there, but there are also some really people who are just, serving up a lot of misinformation and a lot of hype. And I feel just the way I do about investors, like feeling a strong obligation to make sure they're getting a good deal. I feel the same way with respect to students. I feel a really strong, mission about getting good information out to people and frankly, helping them do what I'm doing right now, which is getting my ducks lined up for when the great opportunity arrives, right? So the program that I put together is really geared towards that. It's geared towards helping people, get their broker relationships in line, get their investor relationships in line, really understand their markets, and really be ready to pounce the minute the opportunity is there. Because I having come into the business in 2011, even then, I just remember feeling this great sense of like envy about the people who were in 2009 and buying, buying deals like for pennies on the dollar.
Oh, yeah.
And even by 2011, these guys, some of them were making millions,
Yes.
and so I feel like now we could see the writing on the wall. Obviously we don't know when it's going to happen, but we can certainly start preparing for when it does. And so, part of my mission is to help other people also get ready for that. And I also feel like for new students, people trying to break into this game, they've been fed a lot of hype, right? And they don't understand the market cycle and they think it's going to go on forever. And there's a lot of opportunity for them to get really hurt. So like on the one hand, I want to make sure that they really understand the risk involved. And on the other hand, get ready for when the real opportunity is there. So that's what I'm focused on these days.
Well, let's close with that. Tell more about the course, where they can find it, research you, or because getting it from somebody who's brave enough to call your shot, put it out there in a very logical manner, is what people need to see. It's not all sunshine, rainbows, and unicorns. This is going to hurt eventually. So
and look, like Warren Buffett. I talk about Warren Buffett all the time because I really am a big fan of his philosophy of investing. Mm-hmm. And one of the many great things that he said was, the rule number 1 of investing is don't lose money.
Yeah.
Rule number 2 is refer to rule number 1.
Yes.
Right. And what that means, it's not like, oh yeah, don't lose money. Like that's really obvious. What that means is like, your focus should not be on like how much money you're going to make and how great this could be. Your focus should be on how do I eliminate the downside risk, right? How do I focus on, making sure that everything that I can foresee as a possible downside risk is eliminated. And over the long term, if you just, we live in a wonderful system, right? Like people can achieve what they want to achieve. I mean, it's really terrific, but you have to be like prepared, right? So over the long term, because of the system we have, it's almost like if you just can avoid losing money, you'll make money, right? Yeah. That's really the secret. To make money, just don't lose money. That's why Warren Buffett says that, right? And because the fact of the matter is, you can have a lifetime of success and it can all be wiped out in one swoop,
no
right?
Question. Yes.
So that's what you have to guard against, right? To make sure that your losses aren't wiping out all of your successes. And if you can focus on those downside risks and minimize them to the extent possible, then you're setting yourself up for a really good chance of success. So my program is really designed to help people think about those downside risks and avoid them and just eliminate them from their investing. Mm-hmm. And it's based on mistakes I made and things I've learned along the way. So the way to find that, probably the best way is to join it's not currently open to new members. It will be open again to new members in June, end of June. So the best way to get on the list and find out more about it is I've got a great download that you can get for free. It's called the Ultimate Checklist to Syndicating Deals or something like that. And you can get it. Go to multifamilylaunchpad.org/ultimate-checklist. Okay, so multifamilylaunchpad.org/ultimate-checklist. So you can download that, get on my list, or you can join my Facebook group, Multifamily Investment Community on Facebook. Any one of those platforms will, I'll be talking all about the program when it opens again, and you can learn more then.
Yeah, and I would definitely recommend joining his Facebook group and checking out the checklist because, again, we have somebody who's calling his shot publicly. I think he's right. I think the only question is how long does the party go on? And if anybody's been to a New York New Year's party, they can go on for a lot longer than they should. And I think that's where we are. And we're both Buffett fans. So the one that kind of struck me in this conversation is the one about the tide raising all ships. And then when the tide goes out, you find out who's swimming naked.
Yeah, I love that one. Yeah.
We are about to find it. The question is it 19, 2020, 21, 22? You never know. So I think it's going to happen. Well, Jonathan, this has been so much fun for me. I appreciate you having this discussion. I respect everything you're doing, and I truth be told, have liquidated a couple of apartment buildings already, and I am going to put a walkaway number on a couple of others that I still own because of this conversation. So I appreciate you.
Absolutely. Well, it's been great fun being on the show, and I look forward to talking to you again soon.
You got it, buddy. Take care. Have a great day.
Thank you.